Warren Buffett just made 5 moves that most investors completely missed, and I think at least 3 of them are going to look absolutely genius in hindsight. Here is what most people get wrong about following Buffett. They wait for him to buy something, then they chase the stock after it already moved. That is the wrong approach. The right approach is to understand why he bought, because when you understand the why, you can get in before the crowd does. I went through every single filing, every earnings call, every announcement from Berkshire Hathaway in the last 6 months. And today, I'm going to show you exactly what Buffett and his team are buying right now, why they are buying it, and what it tells us about where the smart money sees the biggest opportunities in 2026. If you want to think like the greatest investor in history and not just copy him after the fact, hit that subscribe button right now. This is exactly the kind of research that changes how you approach the market. Here is what we are covering today. 5 stocks that Berkshire Hathaway has been buying or holding in massive size. One of them is a brand new position that shocked the entire financial world. One of them is an energy bet that oil prices just proved was completely right. And one of them is a company most people wrote off years ago that Buffett just bet $350 million on. Let's get into it. Stock number 1, Chevron, ticker CVX. Most people look at Chevron and see a boring oil company, a dividend stock for retirees. Nothing exciting. Buffett looks at Chevron and sees one of the greatest cash-generating machines on the planet, sitting at a valuation that makes no sense given what is happening in global energy markets right now. Berkshire Hathaway purchased over 8 million shares of Chevron in Q4 2025, bringing its total stake to approximately 130 million shares. Chevron now represents 7.24% of Berkshire's entire equity portfolio, making it one of Buffett's top 5 holdings. Uncoa Marketing. Now, here is the reframe. Chevron is not just an oil company. It is a free cash flow machine with a 39-year track record of unbroken dividend growth, a 3.6% yield right now, and a cost reduction program that makes it more profitable every single quarter, regardless of where oil prices go. Chevron generated record operating cash flow in 2025, achieved structural cost savings of $1.5 billion, and has set a target of $3 to $4 billion in total cost reductions by end of 2026. Nearstream. And then oil went to $100 a barrel. Chevron stock has returned over 26% year-to-date, showing that Buffett's insights were once again ahead of the curve. Uncoa Marketing. Here is my concern. Chevron's performance is tied to oil prices. If crude retreats significantly from current levels, revenue and free cash flow will compress. This is not a tech stock with predictable recurring revenue. My takeaway. Buffett bought 8 million more shares of Chevron before oil hit $100. The math on that decision looks extraordinary right now. At a 3.6% dividend yield with a 39-year growth streak and a cost structure that keeps improving, Chevron is exactly the kind of durable compounder Buffett has built his entire career around. This is a buy. Now, let's move to something that genuinely surprised me when I found it, because this next move tells us something very important about where Berkshire sees value that nobody else is looking. Stock number 2, the New York Times, ticker NYT. Yes, you read that correctly. Warren Buffett, the man who sold every single newspaper he owned 6 years ago and said he expected unending declines for the industry, just put $350 million into the New York Times. I know what you're thinking. That makes no sense. And that reaction is exactly why this opportunity exists. Here is the reframe. The New York Times is not a newspaper anymore. It is a thriving digital subscription business with popular games like Wordle, a well-known sports platform called The Athletic, and more than 12 million digital subscribers. Think about what that actually means. 12 million people paying a recurring subscription fee every single month. That is not a newspaper. That is a media subscription platform with one of the most trusted brand names in the world attached to it. Berkshire established a new position in the New York Times in Q4 2025, buying more than 5 million shares for roughly $352 million. The move reflects Buffett's long-standing admiration for high-quality media franchises with loyal audiences and recurring subscription revenue. Here is the key insight. Buffett sold newspapers because classified ads were dying and nobody was paying for news online. That was correct in 2019, but the New York Times figured out the subscription model before almost anyone else in media. And now they have 12 million people paying every month for content they cannot get anywhere else. Here is my concern. The media landscape is brutally competitive. AI-generated content could threaten premium journalism subscriptions over the long term. And 12 million subscribers, while impressive, still represents a relatively small global audience. My takeaway: when Buffett reverses a position he held for 6 years, you pay attention. The subscription model has fundamentally changed the economics of this business. At current prices, the New York Times is not a newspaper stock. It is a digital subscription stock with a century of brand equity behind it. This is worth serious consideration. Drop a comment right now. Did Buffett's New York Times investment surprise you? Because when I first saw it, I had to read the filing twice. Let's keep going. Stock number 3. Occidental Petroleum, ticker OXY. Most investors know Buffett has been building a massive position in Occidental for years. What most investors do not know is what just happened in January 2026 that makes this investment even more interesting. Here is the reframe. Occidental is not just an oil producer, it is now Berkshire's most direct bet on the structural energy shortage that is reshaping global markets in 2026. In January 2026, Berkshire Hathaway closed its acquisition of OxyChem from Occidental Petroleum. The deal enabled Occidental to cut its principal debt by $5.8 billion, bringing it to $15 billion. Think about what Berkshire just did. They bought the chemical division of one of America's largest oil companies. That is not a passive investment. That is a strategic acquisition that deepens Berkshire's exposure to energy and materials while simultaneously strengthening Occidental's balance sheet. Occidental is a more direct play on rising crude oil prices than Chevron, Exxon, and other big oil companies. And with WTI crude hovering near $100 a barrel, that directness is working in investors' favor right now. Here is my concern. Occidental carries more leverage than Chevron, and its dividend yield is significantly lower at just 1.9% compared to Chevron's 3.8%. If oil prices pull back sharply, Occidental will feel it faster and harder than its larger peers. My takeaway: Buffett has been accumulating Occidental for years and just deepened his commitment with the OxyChem acquisition. This is not a trade. This is a long-term strategic bet on the structural importance of American energy. For investors who share that conviction, Occidental is worth owning alongside Chevron. Here is where the list gets really interesting. The next 2 stocks tell us something important about how Buffett thinks about durable businesses in a world that is changing faster than most investors realize. Stock number 4. American Express, ticker AXP. American Express is one of Buffett's oldest and most beloved positions. He has owned it for decades, and right now it is one of the clearest examples of what Buffett means when he talks about a business with an unbreakable economic moat. Here is the reframe that most people miss. American Express is not a credit card company. It is a closed-loop financial ecosystem with the most valuable customer base in consumer finance. Here is what that means in plain English. When you use a Visa or MasterCard, you are using a network that processes transactions between banks. American Express is different. They issue the card, they process the transaction, and they own the relationship with both the merchant and the cardholder. That closed loop gives them data and economics that Visa and MasterCard simply cannot replicate. American Express remains one of Berkshire's largest disclosed positions, alongside Apple, Bank of America, Coca-Cola, and Chevron. Berkshire's equity portfolio stood at approximately $274 billion at year-end 2025. And the customer profile is what makes this business extraordinary. American Express cardholders spend more, default less, and are more loyal than customers of any other card network in the world. That is not a marketing claim, that is decades of data. Here is my concern. American Express is not cheap. The market knows exactly how good this business is, and in a recession scenario, even premium consumers reduce spending. That would hit American Express harder than a bank focused on mass market lending. My takeaway: Buffett has held American Express through multiple recessions, multiple market crashes, and multiple moments when the market said the business was finished. Every single time, the business proved the doubters wrong. At current valuations, you are paying a fair price for one of the best consumer finance businesses ever built. This is a hold and a buy on any meaningful weakness. One more stock to go, and I saved it for last because I think it is the most important signal in Berkshire's entire portfolio right now. Stock number 5, Berkshire Hathaway itself, ticker BRK.B. Here is something most investors completely overlook. Under new CEO Greg Abel, Berkshire restarted share repurchases in March 2026 after a nearly 2-year pause. The first such program since May 2024. Buffett explicitly approved the timing and valuation. Think about what that means. Warren Buffett, the man sitting on the largest cash pile in the history of Berkshire Hathaway, looked at the current market environment and said the best use of capital right now is buying back our own shares. That is not a casual statement. Buffett only repurchases Berkshire stock when he believes it is trading below intrinsic value. He said exactly that publicly. And the fact that he approved this repurchase program in March 2026 tells you exactly what he thinks about where Berkshire's stock is priced right now. Here is the reframe. Buying Berkshire right now is not buying one stock. You are buying Apple. You are buying Chevron. You are buying American Express. You are buying Occidental. You are buying the New York Times. You are buying BNSF Railroad, Geico Insurance, and dozens of other world-class businesses, all packaged inside a company with zero net debt and the most disciplined capital allocator in history, approving every major decision. Here is my concern. Berkshire's sheer size makes explosive returns difficult. You are not going to get a 10x on Berkshire. What you are going to get is durable compounding with exceptional downside protection. My takeaway: when Buffett says his own company is cheap enough to buy back, smart investors listen. At current prices, Berkshire is one of the best risk-adjusted investments available in the entire market. This is a strong buy. Let me bring this all together. 5 stocks from the most scrutinized portfolio in investing history. Each one telling us something different about where the smartest money in the world sees opportunity right now. If I had to rank all 5 by conviction for new money today, here is exactly how I see it. Number 1 is Chevron. Record cash flow, 39-year dividend streak. Buffett bought more before oil hit $100. The timing on this one was extraordinary. Number 2 is Berkshire Hathaway itself. Buffett just told you the stock is undervalued by approving buybacks. That is the clearest signal he can give. Number 3 is Occidental Petroleum. The OxyChem acquisition deepens a multi-year strategic commitment that is paying off with oil near $100. Number 4 is the New York Times. 12 million digital subscribers and a brand that 150 years of history cannot replicate. Buffett reversed a 6-year position for a reason. Number 5 is American Express. Decades of compounding with a customer base that outperforms every other card network in the world. Here is the investing truth I want to leave you with today. Most investors follow Buffett by copying his trades after they see the filings. By the time they act, the easy money is already gone. The real edge is understanding why he makes the moves he makes, because when you understand the why, you can think ahead of the filing. Every stock on this list was bought for the same reason: a durable business with a competitive advantage, trading at a price that makes sense over a 5 to 10 year horizon. That is the entire Buffett playbook, and it has worked for 60 years. You now understand these 5 positions better than most investors who will blindly copy them. Use that understanding. Disagree with any of these picks? Tell me in the comments, which stock would you add to this list? Which one do you think Buffett is getting wrong? I want to hear it. Subscribe for weekly research on where the smart money is actually moving. No sponsors, no fluff, just the analysis. See you in the next one.